Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about Zoom communications. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. All right, so on Tuesday, we looked at a long call spread in Zoom. I'm showing the long call spread inside the options playbook. We built it as a FOMO trade, fear of missing out. We looked at the chart and very odd, I guess I'd say odd to me, before the pandemic, we saw that Zoom was trading down around the 95 level. The stock made a tremendous run up during the pandemic, and now we find ourselves all the way back to where we began prior to the pandemic. And that was one of the reasons why we're talking about it as a fear of missing out trade. Now, a lot of times when I use that phrase, I'm looking at buying deeper in the money options as a surrogate for owning the stock. A couple examples of that. We went back and looked at Chevron. Oh, not Chevron. Actually, we did Marathon Oil. May have done one in Chevron too. And then also the ETF that tracks the financials. And we looked at those two stocks and we bought deeper in the money call options as a way to manage risk, but still participate in those sectors of the market. Now, this time around, we called it a FOMO trade, but we also did it on a very volatile situation. The implied volatility in Zoom was up over 100% when we were looking at these option contracts, and we're specifically in the month that we were trading. So because of that, I didn't want to buy a call option outright. So this gets to the moral of why we have the stock play of the day, and we have it centered around the options playbook, is that we want to try to figure out the strategy that applies to the market conditions. We always call them paper trades. They're not meant to be recommendations, but even though I'm thinking it as, we're a little nervous about the marketplace still, we're kind of looking for a bounce in Zoom. We're all the way back to where we were before the pandemic. Let's try dipping our toe in the water and managing our risk. If we were thinking about buying 100 shares of Zoom, as opposed to doing that 100 shares, we're going to do one long call spread. So that means that we bought a little bit out of the money option contract, and then we went up 7 points and sold a further out of the money option contract and we had a decent ratio in that we were putting up about 30% of risk on the width of the spread. So we paid around, I think, $265 for the trade. Maximum that it could trade for was $7. So on the downside, we could lose $265, but on the upside, the maximum that we could sell the spread for was $7. Not a bad risk reward scenario. All right. So inside the options playbook, we see the long call spread. The stock this is strike A. This is the expensive option that we're buying. This is strike B. That's the less expensive option that we're selling. The stock in this situation was trading right below strike A when we put this on. So we're saying, let's see if we get the bounce. Let's put this trade on. And if we do, then we can re-examine. Now, this is all with the theory that maybe you wanted to buy 100 shares more long-term for Zoom, but we're down at this bottom. Are we going to bottom at the lows before the pandemic, or do we get a bounce? And if we get that bounce, well, heck, I don't want to miss out on some of that potential upside profit. So, let's see what Zoom has done since we talked about the stock on Tuesday. All right, so here is a 15-minute chart. And we always do it live. So we're always dealing with live markets when we tape the stock play of the day and the overtime. And here is the run-up that we saw in Zoom. Actually, after we got done with the call, the stock made a little bit of a bump down. So this is right around 12:30 right here where my crosshairs are at. Stock went down a little bit, but then from there on up, we've had a strong move all day on Wednesday, all day on Thursday, and here we are on Friday at 108. So we did make that quote unquote dead cat bounce, to use an old phrase that has been around in the markets for quite some time. And we did get to move up to 108 on Zoom. So let's see what happened with our trade. We're going to run over to the Ally Invest option chains inside our live trading platform. On the left-hand side, we have the calls. If you've been here before, you know that. We're up 1.5% today, or $1.60. We looked at the June 17th expiration. Right now, there's 21 days remaining. Now, out of the expiration dates, we chose the monthly, which is the normal third Friday of the month. And prior to weeklies, it was the only month that you could trade. And part of our rationale behind it was the markets are a little bit wide in Zoom. Has a lot to do with the implied volatility, not necessarily the lack of volume, but when you get higher implied volatilities, you're going to get a little bit wider bid-ask spreads just because of the risk to the market makers. So the spreads will widen a little bit. Not to mention, it's not an extremely liquid stock. We're not looking at Apple. We're not looking at Microsoft. Zoom is a very popular stock, but it still doesn't have those type of volumes. Okay. So we decided that we're going to do a spread for those reasons. First of all, when we're doing a spread, we can kind of work the order a little bit because you're giving a buy order and you're giving a sell order. So that allows, when you come down to the marketplace, that gives the market makers a quote unquote hedge. It's a hedged position because you got a buy that wants the market to go up and a sell that wants the market to go down. A lot of times you can get better, closer to the midpoint fills when you're doing a spread as opposed to just buying an option outright. That simple, that straightforward. Part of the reason why we decided in Zoom as our FOMO trade to do a long call spread. Okay, that was one of the rationale that was behind it. So this is the expiration that we chose. Stock was right around 95. I'm going to take a quick peek at my screenshot here. It was at 95.40 when we looked at putting on this trade. And here, the strike that we bought was the 98, and we sold the 105. So in our check boxes, we got the buy on the buy and the sell on the sell. The price that we had inside our right rail, and to make it the official paper trade, was $2.65. That meant our total risk was $265 plus commission. Right now, we had the run up above the strike right at 105. The only downside so far on this trade is that it might have moved too quickly, right? We talked about going out to the June contract. We obviously, well, I shouldn't say obvious, but it would have been better if we would have did a little bit shorter term because we would have got rewarded quicker. But right now we see that it's trading for $4.70. We haven't quite doubled on our position. Now, the maximum that it could trade for would be $7. So stock play of the day overtime is always giving you an alternative. We like to see where the market has moved and maybe discuss a potential adjustment to the trade. So what could we do with this trade? Well, first of all, we could just sell it. We could get out. We do have a profit. Why stick around when, you can't lose money taking a profit. That's always been an adage that you hear over and over again. But I wouldn't do that. I would basically stay the course, and I would have a limit order in to actually sell this fairly close to the maximum. Okay, the maximum it could sell for is $7. The width between the strikes, right, from 105 minus 98, that gives you 7. But that's the maximum it could sell for. I don't ever expect to get the maximum, especially if we have time value, which we have plenty of time value. We're going out to the June 17th expiration. So I would put a limit order in. If this was the case right now and I didn't have this in, I would have a good till canceled limit order in to sell at $6.50, $6.60, somewhere close to the $7 level, but realize that I'm only going to get to $7 very close to the expiration date if the stock is still above the 105 strike, right? That's a big if. All right. So We could also roll this position, and I haven't talked about that. I don't know if we've had this opportunity where the stock has moved so aggressively to the upside over a couple of day period, like we did with Zoom. We had the opposite situation when we talked about Target last week. The stock actually went in the other direction, but we were doing it around earnings. And to me, that's a much more speculative trade to do a long call spread around earnings or any type of trade, as opposed to something where Zoom's already announced earnings, right? Okay. So how would we roll this spread? And you can do it very simply inside the Ally Invest platform. One of the things that I noticed when I was thinking about the overtime edition this week is that under $100, we have 1 point strikes. Right? We have the 97, 98, 100, we even go 103, 105. But once we get to the 105, we go in 5 point strikes. And sometimes around that 100 level, that's just kind of the rule. There's no real rule of thumb anymore as to why they decide that below 100, we're going to go in 1 point strikes, above, we're going to go in 5 point. There used to be a lot of rules in the sand, but nowadays they just kind of do whatever they feel like doing. And by they, I mean the exchanges. So we can't roll to a 7 point wide spread. And I don't know if I would, because if I'm going to roll this position and I'm going to say, okay, I'm up on it, I'm not going to just take my profit and run. I think I still see some more upside. Now that's for you to decide, but let's say I still see some more upside. I'm going to give you an alternative trade, which is called rolling up in strike, but we're not going to go out in time, because our situation here, our problem is that the stock moved too fast to the short strike, and we got no time decay in the short option contract that we have to buy back to close, and hence our profit isn't as good as you may have expected, considering that we blew through the 105 strike, which is our target for the underlying stock, if you will. Okay, so excellent opportunity to show how we're going to roll a long call spread. And inside the playbook, under the management tab, we did actually have a little section on rolling spreads. So I'm going to highlight that in just a little bit. So here we go. Okay, so we were buying this one. This was the initial trade. That's going to become a sell. As a matter of fact, we're going to change that to a sell to close. This we sold, so this is going to be a buy. And then if we roll up, I'm going to keep the same type of theme here. We're at 109, so the market is still moving up. And we're going to buy the just out of the money option, but we're only going to go 5 points wide this time. We're going to give ourselves 5 points of upside. But we want to take some of the profit off the table. We want to make sure that we cover our initial net debit, which was $2.65. We do not want to be playing anymore, have any more risk on this if we're doing this roll. Once again, not meant to be a recommendation. I just want to show you some ways that you can manage a winning position on a paper trade that we do here on Stock Play of the Day. Okay, so now we're going to be buying and selling. This one is going to be a buy, the 105, and we're going to shoot to the 115, and we're going to do a sell. All right, so now if I look at this trade and we go down below, right now we're at a net credit of 258. So we're basically 260 going to receive exactly the amount that we paid for this trade. I have on my screenshot from Tuesday 265, and that's about where the mid price is right now. So that's where I would put it in. I want to take all the risk off the table and hopefully have the probability of making 5 more points on the upside, if I would like to, on this trade. So no more risk on the downside, because $2.65 is what we paid for it. We obviously had commissions in there. You can't forget about those. And now we're going to give ourselves some more upside without any risk on the table. All right, so we hit trade. And you can't forget to make these adjustments, because the Options Clearing Corporation wants to know if you're opening or closing. So this is going to be a sell to open. This would be a sell to close. That's a buy to open. We sold it initially. That would be a buy to close. And 265 net credit. We're going to do credit, and we're going to make it 265. We want to get filled at 265, or I don't want to do the trade, right? Because that's what we paid for it initially. And we're up on the trade right now. So bottom line is, if I'm going to roll this, I'm looking for some more upside. I want to take some risk off the table. This is one way that I could do it. Not saying it's a great trade. I'm not saying it's a bad trade, a good trade. It's just something that you can do, and that's what the stock play of the day overtime is all about. And I find it very interesting that we can roll this for a net credit of exactly right now what we paid for it on Tuesday. That means that if the stock goes up to 115, we can have the potential to make $5 or $500 for every 1-by-1 spread, less commissions, with no risk on the downside. A way to say it is to say that we'd be playing with the house's money at that point in time. We're going to take the money off the table, stick it in our pocket, put on this trade, still gives us five more dollars of upside potential. All right. Well, I have to inform you that we are going to be we're going to add the stock play of the day the overtime edition into the stock play of the day. So no longer are we going to have the Friday edition, but on Tuesday, we're going to go through and we're going to talk a little bit more about the option trade and then also review the trade from the week before. That's our goal. We're going to try to test it out here. And please click subscribe, ring the bell. And next week, we'll have the chat box open up. Tell us your thoughts. Let us know your feelings about adjusting the stock play of the day. And please share with friends, families, relatives. We want, this is free for all. You don't have to be an Ally Invest client in order to partake, but we would love it if you would share it on all social media platforms. Thanks for coming, everyone. And we'll see you this coming up Tuesday for the next stock play of the day.